Hello friends, welcome to my weekly market outlook video wherein we discuss using very basic but highly accurate in-house exclusive indicators as to where the markets are headed. This is a thinking man's video and welcome to my weekly market outlook video. Last week, in my video, the thumbnail that appears on your screen said that the market would go up. Statistical probability indicated that the markets would go up in spite of all the bad news, and look at the way the markets really rallied. The bank Nifty rallied a little under 5% and the Nifty went up a full 3%. Are the bulls back in charge? Are they going to pick up the thread on Monday where they left off on Friday? We are going to examine that in this video. So let's dive right in. Coming up on your screen is the market roundup window, which, like I said, the market is led by the banking space. So the bank Nifty outperformed the Nifty 50 by almost 2 percentage points. The US dollar index eased a little bit, which is good for emerging markets, including India, because a rising dollar is deemed as inflationary for emerging economies. Oil fell 12.5%. Now, that was another sigh of relief for the equity markets, and therefore there was a good cushion on the downside. Natural gas prices rose, but marginally. The fact that silver and gold fell tells you that safe haven buying eased off, and the 10-year benchmark bond yield fell from 6.82 to 6.79%, and that had a salutary effect on the bank Nifty. Last week, I explained to you how the bond market is ignored by bank Nifty traders, because when the bond yields are rising, which means bond prices are down, banking stocks take a lot of mark-to-market hit, and that creates a pressure on the bank Nifty. Here you are, that hypothesis is validated. When bond yields fell, bank Nifty rose. The NSE gained 3%, a little over 3% in market capitalization on a week-on-week basis, which is an excellent plus point. And the fact that the Nasdaq and the S&P 500 edged up marginally, in spite of the fact that the Dow Jones fell 0.12%, tells you that the overseas cues were not all that bad at all. Now, let's go to the market-wide position limits. On the daily chart, you can see that the expiry on Thursday saw 19.29%, and there on Friday you have it, a smart uptick coming in, which is along routine lines. On the weekly chart, you can see how the MWPL tends to crash down in the expiry week, only to pick up for the next 3 to 4. 3 weeks is more of a norm, but in the run-up to the March expiry, the MWPL actually rose up on 4 weeks. So now you're going to see a run-up till the 3rd week of April. But what is important here is whether the MWPL goes past the 30% mark in the April expiry. That would tell me that the two Marshmallow traders are showing some amount of risk appetite. The Marshmallow Theory is given in this video, the thumbnail of which you can see on your screen, and the links to these videos are in the description below this video itself, and they will also come in the end screen of the video here. Let's now see the index and stock futures turnover on the daily chart on your screen. We've seen a massive collapse in stock futures turnover, which has come down the hill both on Thursday, where the decline started in the turnover, and on Friday it collapsed. Well, part of the reason is that on expiry, or in the run-up to expiry, turnover rises. The reason being that traders square up their positions in the March derivative series and initiate the same exposure in April, and therefore the turnover is recorded twice. That apart, we'll need to watch what's happening in the week ahead, and even the index futures turnover seems to have eased from its peak. We need to keep our ears to the ground. Now, turnover is a one Marshmallow trader sentiment tracker, whereas MWPL is a 2 Marshmallow trader sentiment tracker. So what we are seeing is that both the 1 and 2 Marshmallow traders are a little cautious. Now, the turnover on a week on week basis, you can see that the index futures turnover on the weekly chart has gone up, whereas the stock futures turnover has come down. Indices tend to be a lot more safer in perception. The reason being that indices don't fluctuate more than 1.5-2% intraday, whereas stocks can go between 3 to 4% intraday volatility. And that tells me that traders were playing a low risk game. Understandably so. It was end of the financial year, March end. People are normally cautious with where they trade their money. Now we see the NSE and the Nifty and the Bank Nifty prompt month, the April month basis. Basis is nothing but the futures premium over spot. On Thursday, the basis expanded. Not a surprise because it's a new derivative series. People are getting 4 weeks to play around with, and therefore they pay a very steep premium. And on Friday, the basis for both the Nifty and the Bank Nifty came down sharply. The Bank Nifty's basis actually fell sharply because of profit taking and hedging. Do remember that the Bank Nifty rose more than the Nifty on Friday, and delta hedging and tail risk buying has eased off the basis. On the weekly basis chart, you can see that the Nifty's basis continues to rise for the 6th week in a row. That means the one Marshmallow traders are showing greater risk appetite for the Nifty 50. Where the Bank Nifty is concerned, the basis shot up in the expiry week last week and it has come down sharply for the Bank Nifty. Because of the sheer volatility, people are not taking naked exposure. They are hedging their bets and therefore the basis came down. Now, this kind of volatility in basis is not exactly a very welcome sign. It drives up the statistical beta or the pure price volatility on individual stocks as well. So do keep monitoring this aspect. Connect with me on social media. My contact coordinates come at the fag end of this video, wherein I update all these charts on a day-to-day basis on my social media account. End of the day, you can basically keep yourself updated in real time. Let's now see the NSE advanced decline ratio, a very simple metric of the one Marshmallow traders. It basically tells you how many shares rose versus how many shares fell. This is the daily chart here, mind you. On Friday, the day was more of a game changer because the number of shares advancing were a little more than 5 for a number of shares declining. So the gainers were 5 times more than the losers, and this is a huge jump which probably may not be able to sustain as far as the advanced decline ratio is concerned. One gets a feeling that there's been a lot of short covering, panic-based short covering coming in, which is what explains the advanced decline ratio that we are seeing of such a steep magnitude. Now let's take a look at the weekly advanced decline ratio. You can see last week's advanced decline ratio on Friday was 0.5 and now it's jumped 10 times to 5.01. This is in the uppermost end of the 20-week range because this is a weekly chart, and I do feel this kind of advanced decline ratio may not be able to sustain. So some profit taking in the latter half of the coming week might be seen. Now let's see the impetus chart. Now this is an indicator that you've loved, depended, trusted and traded on for a couple of quarters now. What you are seeing is that the impetus for the Nifty rose sharply on Friday, whereas the Bank Nifty's impetus started edging up on Thursday itself. Not surprising because the Bank Nifty outperformed the Nifty 50 last week. But the impetus has risen from a 20-period low. Now, this kind of impetus is extremely poor. And when it bounces from here, remember what I've told you last week also. When the impetus is this low, the chances of very large price moves coming in very suddenly are elevated. And that's precisely what happened in the Nifty and Bank Nifty on Friday. Now that impetus has started rising along with the price, I think the quality of buying seems to have been good on Friday, which is why you can, barring unforeseen circumstances or new fresh developments after I record this video on early Saturday morning on the war front or any other aspect, I think barring all those circumstances, one would expect a bullish opening on Monday. Now let's take a look at the weekly impetus chart. You're basically seeing that week on week, this is the fourth week the bank Nifty impetus has fallen, and the third week the Nifty's impetus has fallen on a week on week basis. Impetus still remains extremely low, and whenever it reverses, it is likely to cause huge price volatility. So you be very careful out there still. Now let's see the LWTD indicator, something that you've learned to trust over the last 2.5, 3 weeks. You've tried and tested it, and whenever the markets were making you complacent that they are going to go up or go down for sure. And this indicator has given you a contrary warning. It is this indicator which has prevailed rather than your gut feeling. This is a very bankable indicator, and what you can see on this daily LWTD chart is that the LWTD indicator rose on Thursday, consolidated on Friday, but still remains above zero. And the Nifty itself, which is indicated by a blue line, the percentage gain or loss of the Nifty. Remember, this is not the absolute Nifty value, it's a percentage gain or loss over the previous day, has also shot up on Friday. So what has happened is, after a fairly long time, you're seeing the LWTD and the Nifty gain loss in percentage line rise up together, which again raises the probability that the markets might open higher on Monday, barring any unforeseen circumstances or fresh bad news. Let's now take the LWTD chart on a weekly compression basis. Here again, you're seeing the Nifty gain loss percentage blue line going up sharply, and the LWTD, which was positive last week itself, which is why I, in my last week's video, told you that the statistical probability of the market rising was far better than the market falling. So ignore all the bad news. The markets might just go up. And the LWTD weekly chart seems to have gained strength. So I'm hoping that markets will get bought into on declines, if any. And unless the news is really horrible, the market should continue to remain firm. Friends, let's now go to the four market participant types and gauge their footprints. We start with the FIIs, who've basically reduced their stock futures net longs, as you can see on your daily chart, whereas they've increased their index futures net long positions, which seems to be somewhat of a hedge. Where DIIs or domestic investment institutions are concerned, their stock futures net short positions have gone down marginally, but they've pressed additional short positions in the index futures, as you can see on your screen. So they've basically reduce their shorts in stocks. Let's now see what the prop traders are doing. Now, these are very sharp, super savvy traders. They are brokers' own trades. They know who's buying and selling. They are second best to insiders. And the prop traders remain short on the index futures, as you can see on the blue line. And their stock futures long positions have jumped. Part of the reason why a jump is apparent is because on expiry, they may not have necessarily rolled over their positions. Remember, these are savvy traders who are brokers themselves. So paying cost of carry may not really be their thing. Now let's see what the retail traders have done. Do remember that it's the retail who's been doing all the heavy lifting where the buying is concerned over the last 18 months or more. And the retail guys continue to reduce their individual stock futures net long positions, as you can see on the red line. And where their index net longs are concerned, they have reduced their net long position substantially. They even went net short on Thursday's end of the day data. So the retail guys are slowly but surely unwinding their long positions. Whether it means that retail selling will topple the market or it will halt a rally, that we will have to see day on day basis. Each new day will bring us new metrics. So, friends, the indicators segment done. I now go towards the bank bond yields. And this is the most important market and unfortunately absolutely forgotten and skipped out by bank Nifty traders. It has a direct correlation with banking stocks because bonds are usually purchased by banks, and any change in bond yields affects the mark to market position of banks. So, what we did see was that the bond yields eased last week, and that means the bond prices went up. So the mark to market position of banks improved, but what we are seeing is that bond yields remain in the upper half of the range of the last 6 months, and the RBI has given a kind of a guidance that they are likely to raise approximately 14 lakh 50,000 crores from the bond market through the bond issues. Now, do remember that the RBI Retail Direct Scheme, GSEC scheme for individual investors is open. You can go to that portal, open an account, it's free. You can invest money in bonds and T-bills, etc. No brokerage, no commissions, and no other charges will be charged to you. You can buy and sell directly from banks who are using the RBI's online trading platform to monitor their bond positions. So you will get excellent returns far above your bank fixed deposits, and bank FDs are guaranteed up to 5 lakh rupees per individual. But bond markets, the sovereign guaranteed bonds are 100% secure. You can invest 5,000 crores and the government is bound to honor all the money rather than just 5 lakh rupees. So what you are seeing is basically bond prices rise up as expectations of inflation went down because oil prices have eased last week. This is good news for equities, and as long as inflationary pressures are subdued, I think financial asset class markets will continue to remain optimistic. Friends, now let's go to the US dollar index, a very critical benchmark because emerging market economies do take a lot of cues from this index. Now, the US dollar index fell only on 2 out of 5 trading sessions last week, as you can see on your screen, but those falls were big enough to basically result in a net loss on a week-on-week basis where the Dixie is concerned, or the US dollar index, as it's called, Dixie by traders. Now, the price has gone below the 25-day exponential moving average, which is a proxy for 1 month long holding on cost of an average bull, but closed above it on Thursday and Friday. Price remains above its bullish trend line, which is a dotted blue trend line. You can see that. It's a fairly reliable trend line, 9 months old in duration. And as this index approaches 99.5 levels, you're likely to see more and more selling pressure coming in the absolute near term. And 97.5 or thereabout should be a swing low support for the Dixie index. Friends, let's now go to the weekly chart of this Dixie. What you are seeing is a small bodied candle with fairly large wicks on both, shadows or wicks on both upside and downside, which tells you that there was a lot of thrashing about between the bulls and bears, even though the open and close were fairly close to each other. So volatility was fairly high, but the price remained above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull, which means the medium-term outlook also remains positive for now. Last week, I advocated a range between 100.10 on the upside and 97.55 on the downside, which held perfectly well. In the coming week, I estimate a range between 99.90 on the upside and 97.25 on the downside. Friends, do keep monitoring this index because a lot of your commodity trends, bond yields, as well as equity market trends depend on this. The bond market's done. I now go towards the bank Nifty, which was clearly the star of the week. Last week, it gained 4.91% and it rose on all 5 trading sessions last week. The game changer, as you can see on your screen, was clearly the big bullish candle on Friday. Friday, it logged the largest gain by any metric whatsoever. The price is above its 25-day exponential moving average, which is a 1 month long holding on cost of a bull, and the average itself is turning higher. Both are positive indicators for short-term traders, and the short-term trend remains optimistic as long as the price remains above its 25-day exponential moving average, somewhat approximately at 36,000 levels. Let's now go to the weekly chart of the Bank Nifty, wherein what you are seeing is a bullish engulfing candle, where the last bullish candle has clearly overpowered the prior bearish one. The body is engulfing the previous candle's body. Price is now above its 25-week exponential moving average, which is a 6-month holding on cost of a bull, which means the medium-term outlook is slowly but surely improving. Now, what we do need is continued buying support and the market to stay above the round number of 36,500 or 37,000, and the bulls can basically dominate the market. In the week before last, this index was number 2 on the most volatile counters list on the NSE the derivative segment, which I told you was precarious because an index remaining number 2 tells you that the market volatility or the sectoral index volatility is extremely high. Mercifully, this index has fallen a few notches and closed at number 5 on the most volatile list. And it's also partially because the stock volatility, individual stock volatility has risen. So that basically has pushed this index down 3 notches last week. Do keep monitoring this aspect and keep your ears to the ground. Last week, I estimated a range between 37,325 on the upside and 33,500 on the downside, which held perfectly well. In the coming week, I expect a range between 39,100 on the upside and 35,225 on the downside. Friends, I now move to the Nifty 50, the most liquid and low impact cost derivative traded instrument on the NSE derivative segment. It rose 3.02%. Rose on 4 out of 5 trading sessions, as you can see on your chart on your screen. Friday again was a big upthrust day. The price has remained throughout the week above its 25-day exponential moving average, which is a month-long holding on cost of a bull. So the short-term outlook remains positive for now. And going towards the weekly chart, one sees a big, powerful, bullish candle on your screen. And it's taken support at the 25-week exponential moving average, which is a 6-month holding on cost of an average bull, which means the medium-term outlook is also optimistic for now. Remaining above the 17,250 to 17,350 band should be a positive confirmation for the bulls. And I would watch this band as a semblance of short-term support. Friends, in the week before last, this index was number 9 on the most volatile list, and it has fallen 3 notches to number 12, which is again a good sign because indices should not be as volatile as they have been in the last couple of weeks. Last week, I estimated a range between 17,825 on the upside and 16,475 on the downside, which held perfectly well. In the coming week, I expect a range between 18,350 on the upside and 17,000, round number, 17,000 on the downside. The dice is clearly loaded somewhat in favor of bulls. So I think the Jensen's measure and the Traynor ratio have become somewhat better. They're not outright bullish. Be careful out there. They're not outright bullish, but they've improved over the previous 2 weeks. So the odds are somewhat in the bulls' favor. Friends, the indices done. I now come to the most popular segment of this video, wherein I give you 5 stocks which are high impetus, high beta, and 5 stocks which are low impetus, low beta. High impetus stocks take small exposure, wait for large price moves. Low impetus take big exposure, wait for small price moves. Different traders, different risk appetites, different attitudes and aptitudes. Therefore, my strategy differs. So the high beta list is led by Adani Ports at number 1, followed by GAIL, Gas Authority of India. Number 3, BHEL, Bharat Heavy Electricals. Number 4, Canfin Homes. And number 5, Grasim. The low beta, low impetus stock list is led by Trent, number 2 PEL, number 3 Vedanta, number 4 Star, and number 5 SRF. Friends, this hierarchy of high and low beta stock changes from day to day, hour to hour, because volatility compresses and expands on an hourly basis. So do please connect with me on social media. My contact coordinates come at the fag end of this video, wherein I update all this critical stuff end of the day on my social media accounts. And before I draw this video to a close, let me remind you to subscribe to my YouTube channel if you haven't already done so. Click like on this video if you found it useful for your trading next week. Good, bad, or ugly, your comments are always welcome, and I value your feedback and look forward to hearing from you. Also, please help me reach out to a wider audience and spread the cult of knowledge and rational-based investments and trades by referring my video to your family and friends. In the description below the video is a hyperlink to my playlist on Equity Masters YouTube channel. Do subscribe to that as well. Friends, I thank you for your patience and being with me in this video. Till we meet again in my next, this is Vijay Bambani signing off for now. Take care. Have a very, very profitable week ahead. Bye-bye and thank you.